We have weathered the 2008 financial crisis and collapse of Lehman Brothers, the 2020 COVID pandemic, and now the Silicon Valley Bank collapse that put the markets in turmoil. What's next? Every few years, something happens and throws the stock market into turmoil. It's inevitable, and it's going to happen again. The question is, are we prepared for it? In this video, we discuss what do we do in the financials after the recent Silicon Valley Bank collapse? How do we protect against a further overall fall in the market and not miss the move up? And finally, how do we ensure that we don't get slaughtered in the next crisis and drop in the market?
Hey guys, Darren here. Thanks for joining. We talk about action steps you can take today to increase profits and reduce risk in your options trading portfolio. Please check out and download the free options workshop in the link below.
It talks about the two main reasons why options can be less risky and more profitable than just buying stocks alone. It also details how to profit in both directions and pick your win percentage, which you can't do by just buying stocks alone. Also, please hit the like and subscribe buttons below. I appreciate it and it helps the channel. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What do we do in the financials after the recent Silicon Valley Bank collapse? We always want to take all factors into account when we're trading stocks and options. It's sometimes hard to understand how things will unfold, especially when they often don't seem to make sense. When things like this happen, we need to look at the facts and go by them. I covered some of these in the last video I'll link to below. We took a close look at whether the collapse was contagious and could lead to other bank collapses as well. First of all, the big banks like Bank of America, Chase, and Wells Fargo are much more balanced and not leveraged to tech startups like SVB was. Secondly, Biden just bailed out the companies that borrowed from the bank, indicating that they would not lose their money, and interestingly enough, the taxpayers wouldn't pay for the bailout. We all know that it will trickle down to the taxpayers footing the bill, so don't buy that. Bottom line, when you look at the low PEs of 11 for the bank stocks right now, they are super cheap. Also, financials are expected to be one of the sectors that has the most revenue growth in the second half of this year. For those reasons, I like to be long the big banks like JP Morgan Chase, Wells Fargo, and Bank of America. How do we protect against a further fall in stock prices and not miss the next move up? We trade both sides. We've covered previously that stocks trade in both directions since the market is efficient and there has to be both buyers and sellers. So even if we think we know a stock is moving up long term, it will move down about 50% of the time in the short term. For this reason, we trade both sides of the market. We also want to try and be fairly close to delta neutral so that we can collect money when the market moves down as well as up. So how do we trade both sides of the stock market? I covered this in some detail in the free workshop. We put on opposing side trades on big movement days. On stock market big down days, when the market moves down, IV typically increases and option premiums increase. So it's generally a good day to place new trades and collect larger premiums when we sell options, which is what we prefer to do. I may be long stocks and have a couple hundred positive deltas. So then I need negative deltas, so I put on iron condors or strangles and trade both sides. Why is that? Shouldn't I only be putting on negative delta trades like selling calls and call verticals to become more delta neutral? Not necessarily. I still like to put on neutral trades because the market can still go either way and I can collect good premium with the increase in the implied volatility. On stock market big up days, I like to add negative delta. If IV is super low, I use debit spreads. If it's decent IV, I sell call credit spreads or calls. If I own stock, I'll sell a call to make it a covered call. If I own leaps, then I'll turn it into a poor man's covered call by selling a call to reduce the cost basis. Since we are generally long stocks that we think will outperform the market, I like to use ETFs like SPY and the Qs to short the market. How do we ensure that we're ready and don't get killed in the next big crisis or drop in the market? We stay small. When trading options, we're using leverage. So we don't need to trade as big or as much to make the same amount of money as we would if we were trading stocks alone. So we need to stay small to avoid losing a lot on a big move. As you become more experienced, you will become more comfortable in knowing what your max lot size is. You may want to be a 1, 2, or 3 lot trader. It really depends on your account size. If you are a 3 lot trader, you should start with 1 lot. If the trade goes against you and you still believe in the fundamentals of the company, then you add a 2nd lot and then finally a 3rd lot as your max. You should limit your max amount of capital per underline so that you don't put all your eggs in one basket. For instance, you don't want to have 30% of your trading account in bank stocks when they take a hit. I like to have no more than 5% in any one underline. You should always be aware of how much you are trading long, short, and in total. When the market is at all-time highs and 30 to 50% above the average S&P trend lines, I like to have a lot of my money on the sidelines waiting for a drop. With the market at highs, the risk is much more to the downside versus the market skyrocketing up even further. At the same time, when the market is at lows and 30 to 50% below the trend lines, I like to be more invested, maybe 85% or so invested for a small account and maybe 50% in a large account. I will also have more long trades on, knowing that with the market at lows, the risk to further downside is limited. With PEs at lows and positive earnings in the second half, the big banks look good right now. Look to trade both sides of the market and benefit by placing new trades on big up and down days. Lastly, always stay small and aware of your capital at risk. This way, you avoid losing lots of money and have capital on the side ready when a big move does occur.
All right, guys, I put a link down below for the free options workshop. Be sure and grab that. Also, let me know what you thought of this trade and what you're trading in your options trading account. Thanks for watching and see you in the next one.